Okay, good morning everyone, and welcome to this press briefing on behalf of the International Monetary Fund on the occasion of the staff concluding statement on the United States Article IV Consultation. I think the document has been distributed to you already, so you've had a chance to look at that. This morning we will be on the record, and I'm very pleased that we have with us the Managing Director of the IMF, Madam Christine Lagarde. We also have, to my immediate right, Alejandro Werner, who is the Director of our Western Hemisphere Department. We also have the Deputy Director of that department and Mission Chief for the United States, Nigel Chalk, just immediately to the right of the Managing Director. And way over on the far right is Daniel Lay, who is the Deputy Division Chief in the North American Division. So we'll get to your questions as soon as we can, immediately after opening remarks from the Managing Director. And let me just say that the Managing Director is just about to step onto a plane to go to Japan for the G20 meeting. So she will be leaving us after she makes some opening remarks, and the rest of us will stay to take your questions. Madam Lagarde.
So thank you, Jerry, and good morning to all of you. Let me just start by remembering that today is June the 6th. And on June the 6th, 2019, there's a lot that the Americans can be proud of. And not just because of their illustrious past for having led that journey to freedom that liberated most of Europe and which is being celebrated today on its 75th anniversary, but clearly also for leading this unbelievable multilateral efforts that took the life of so many and brought life and light to so many others. Now, I'm saying that because, obviously, in addition to that, the Americans can be very proud of the economy as it stands today. In a matter of a few weeks, the US economy will be in the longest expansion in recorded history. And this is an important achievement that is driven by a robust private sector demand and by policy choices that have helped spur growth and job creation. Speaking of jobs, unemployment is at levels not seen since the late 60s. And wages and households' incomes are rising as well. And this is happening at a time when inflation pressures in the US remains very subdued. Our assessment is that the economy will grow this year at about 2.6% and next year at around 2%. And this represents an increase from our initial growth forecast by 0.3%. So lots of positives and a lot to be proud of on the economic front. And the economic indicators are saying so. But if we look at a few other indicators which actually matter, the social indicators, there is a lot of room for improvement. We see a challenging picture. Average life expectancy has trended downwards in recent years. Income and wealth polarization have increased. Social mobility has steadily eroded. Education and health outcomes are suboptimal. And while the poverty rate is falling, it remains higher than in any other advanced economies. So we believe that more attention should be paid to promoting inclusive and sustainable growth. More attention should be paid to social outcome into line with the macroeconomic very good developments that we see. And there are policies that can actually achieve that. There are many policies, and we've mentioned them over the course of our previous Article IV reviews. So I will mention a few of those which we believe would actually rally the support of many. Instituting paid family leave comes to mind. Expanding the very effective earned income tax credit that the world envies the United States. helping working family with child and dependent care. All of this would provide a lifeline to families and help support social mobility by making it easier for them to enter the workforce and pursue a fulfilling career. And speaking of life expectancy, we would like to highlight the important work that is underway by the federal, state, and municipal governments across the country to tackle the current opioid crisis in the US. The human costs of this epidemic are tragic, and while we know that there is no easy solution, it is rightly a bipartisan priority of the administration and of Congress. Economic indicators, social indicators. If we now turn to markets. Over the first few months of this year, financial market conditions have improved markedly. This is good for near-term growth, reducing the cost and increasing access to financing. But obviously we're concerned about the risk of an abrupt reversal of financial market conditions that could represent a material downside risk in the US. And in particular, a sudden tightening of financial conditions could interact adversely with the high level of private, public, corporate households and sovereign debt, and could create a feedback loop that would also weigh on real activity and job creations. Not to mention the fact that if that was to happen, it would not only have an impact in the US economy, but it would also have spillover effects beyond the borders of this country. Now, let me say a few words about debt. We have highlighted in past consultation that the US public debt is on an unsustainable path. We believe that policy adjustments are needed in order to lower the fiscal deficit and to put public debt on a gradual downward path over the medium term. And there are, yet again, a range of possible options. However, in our view, any successful package will likely require steps to address the expected increases in entitlement spending on health and on social security. It would also include raising indirect taxation and instituting, as we have said many times before, a federal carbon tax. Turning to monetary policy. As you know, earlier this year, the Federal Reserve has indicated that it was pausing its process of raising interest rates. We fully agree with that approach and believe that this will give policymakers time to gauge the balance of risks to both inflation and unemployment outcome, and to build a clearer picture of whether further adjustments in the federal funds rates are warranted. Whatever the developments, we believe that it will be important for the Fed to continue to be exclusively data dependent and to continue to communicate well as it has on its assessment of the economic situation and its expectations for future monetary policy. Let me now close with something that is much talked about, and that has to do obviously with trade. We believe that for the global economy to actually function well, it needs to be able to rely on a more open, more stable, more transparent, more predictable, and rules-based international trade system. And as such, it will be essential for the US and all its trading partners, including the likes of China, Mexico, and others, to agree on a new system, to agree to eliminate the distortions that put a brake on growth, and that not only will affect the economy of those countries directly impacted, but will also have spillover effects way beyond the shores of those countries. And we very strongly believe that a better integrated international trading system is actually conducive to that sustainable, strong, and balanced growth that is so much needed. And as I've said many times, nobody wins a trade war, and everybody suffers. With these brief remarks, I will exit the scene. I will join colleagues in Fukuoka, Japan, And I'm sure that we will be discussing these findings as well as many other economic considerations that obviously you are familiar with. Thank you very much. And I leave it to you for questions to my eminent colleagues. Thank you.
Thank you very much, Madame Lagarde. Okay, so we'll turn to questions in the room, and I know we have many colleagues watching us online as well. But let's turn to your questions in the room. Please try and keep them succinct, and we'll try and take as many as we can. So, questions, please. Good morning.
Hi, good morning. Thank you, Gary. My question is, so like the reporter mentioned the trade tensions, but I'm wondering, does the technology decoupling between US and China take consideration in this report? Can we quantify the impact of that potential decoupling, which might have potential impact on not only US and China, but the global technological development? I'm just wondering, how do you see that going to influence the U.S. economy? Thank you.
So, I mean, certainly we think that those issues are important. They're much more difficult for us, I think, to model than the trade tariffs. We've been looking at trying to think about how to model those things, but it's quite complicated. I think we have a reasonably good read on how much trade disruptions can distort both the U.S. economy and the global economy and lead to headwinds to growth. And we've put out some of that work in the April 2019 WEO. I think we have not yet put out work on the technology, but it's something we're looking at and working on.
Thank you, Nigel. Rafael.
Thanks, Jerry. Rafael Matus from La Nación newspaper from Argentina. In the report, you speak about spillover effects from the trade war to other countries. I was wondering if you could elaborate a little bit on what could be the potential spillover effects to the hemisphere, and particularly Argentina. Thanks.
I mean, in several studies, we have looked at different channels of transmission. I mean, obviously, you have the direct channel through the trade that the different countries involved in trade negotiations, the impact it can have to third countries. And we saw some of those effects in play last year, especially with agricultural producers that saw an increase in their exports to some of these countries. But overall, and especially given the increasing uncertainty that we are seeing, the effect of uncertainty on investment, our estimates show that for almost all the third countries, once this uncertainty and market effects are taken into account, everybody loses. And although you can have, just summarizing, some trade diversion, and these trade diversion effects can be positive for some countries, once you add, and we're seeing some of those effects play now, and we also saw them play out in the fourth quarter of last year, uncertainty hitting the markets and uncertainty hitting the investment process around the world, then almost everybody ends up being affected negatively. That's what we've seen. For the case of Argentina, as I said, I mean, you might have some positive effects coming through agricultural exports, etc. But most of all, once you have uncertainty affecting investment decisions and leading firms to postpone decisions until there's more clarity on the rules of the game, and also uncertainty hitting markets and therefore postponing financing decisions, etc., obviously this is negative for almost everybody around the globe. And that's why the MD says nobody wins with a trade war.
Thank you, Alejandro. Alfonso, Efe, thank you.
Hello, Alfonso Fernandez from the Spanish newswire EFE. Do you have a first assessment of the potential effects of the tariffs on Mexico for the US and also for Mexico if they are put in place starting on Monday?
So I think it's pretty clear that the effects of tariffs on Mexico are certainly larger as a share of GDP for Mexico than they are for the United States. But I think both sides, both countries have a negative effect, and it's quite pronounced in certain sectors, particularly those sectors that are very integrated across the border. So, for example, in sectors such as automobiles and transportation, I think, and agriculture, where there's a lot of two-way flows across the border, they tend to have a large sectoral effect. Even if the overall macro effects are not as large, the sectoral effects can be quite pronounced. We don't have any specific estimates of the effects of these tariffs, but it's something we're looking at.
Thank you, Nigel. Yes, sir.
Yes, thank you. I'd like to ask whether you have been able to model the effects on the U.S. economy of the trade measures that have been adopted by the United States so far. There were the steel tariffs that were adopted under Section 232. Then there has been a succession of tariffs imposed on China. Has that had any effect on the U.S. economy? And if so, can you quantify that? Thank you.
Yep. So the way we approach our forecasting is we already build into our forecasts the policies that have been put in place. So, for example, the steel and aluminum tariffs and the tariffs on China, we actually have built into our forecast. The policies that are not yet in place, such as those tariffs proposed for Mexico, we do not build in until they're actually in place. So if you look at our forecasts that we just released, those tariffs that are in place are already embedded in that forecast. Of course, there's offsetting factors with, things that are happening to inventories, things that are happening to consumer demand. So you're only seeing the net effect. I think in general, what we've seen so far in terms of the tariff effects have been a modest headwind to the U.S. economy, particularly the tariffs that have been placed on China. They've been more of a headwind in particular sectors and in particular states than they have for the economy as a whole. We have not yet seen a large impact of the tariffs on consumer prices, although we do see their effects on import prices. So we presume that they are being somehow absorbed in the production chain, either through profit margins or some increasing efficiencies in production. But we're not yet seeing them passing through into consumer prices. That doesn't mean that they won't pass through, because it takes some time and there's some lags involved. And certainly if the tariffs are increased, we would expect eventually those effects to turn up both in more pronounced in activity and then also in consumer price inflation.
Thank you, Nigel. I think there was a question from Bloomberg in the front. Thank you.
Very similar question, just piggybacking off of those, but could you talk about the potential increased risk of a recession in the U.S. And the potential spillover effects, as Madame Lagarde mentioned, in relation to the trade tariffs and slowing growth?
Yeah. So I should say that we don't see recession as a likelihood in our baseline in the U.S. It's certainly always a risk that we consider, but it's not in our baseline. We instead see a gradual slowing of the economy to a point where the economy slows down a little bit below the potential growth rate, since right now the economy is actually quite a bit above where potential growth is. I think Madame Lagarde highlighted what we see as the principal risk, which is actually a risk linked to financial conditions. But I think we've seen that the trade tensions and financial conditions are actually quite intimately connected, that as trade tensions and uncertainties increase, as Alejandro said, that's reflected also in market pricing of equity prices, risk spreads, and that then feeds into activity. And so the idea that right now, financial conditions are providing some support to growth. But as we saw in the fourth quarter of last year, once those financial conditions tighten, they feed quite quickly into activity and into a slowdown of activity. And that's kind of the principal channel by which we see, for the United States at least, and for other countries through spillover effects, that this will be the sort of predominant channel by which activity would be affected, is that sort of uncertainty about trade and about policies creates risk aversion, which then leads to a tightening of financial conditions, which then feeds into a slowdown of activity. And that's the sort of, I think we've highlighted that as the risk that we're most concerned about for the U.S. economy.
Thank you. Lady in the front here, thank you.
Maolin Shang with Xinhua News Agency. You said that tariffs only put in place are considered in this estimation. So I was wondering whether you could tell us if U.S. go through actually implement the $300 billion of products for Chinese imports, how would that impact your estimation? And also generally, if China-U.S. trade tensions continue to escalate, how do you see the future of the U.S. economy? Thanks.
Yeah. So on the general question, an escalation in trade tariff is an unambiguous negative for the U.S. economy, and for its trading partners. In terms of the quantification, we actually did put out in the April WEO, in Chapter 4 of the April WEO box, where we looked at the impact of a 25% tariff across the board on Chinese goods. So I would refer you to that. For the U.S., over the long run, it reduces GDP by around 0.3% of the GDP over a longer term, a little bit less in the shorter term. Obviously, those estimates are very uncertain, and I think those estimates, when we put them together, had a relatively benign view of how much those tariffs would feed through into financial conditions. So if that channel is more pronounced, if risk aversion is much higher, then you could expect to see larger macro effects in the U.S. and abroad.
Thank you. Anything further in the room? Okay, we can take one more round. Let me start with ladies. Bloomberg.
Wanted to ask you about the fiscal deficit, which was another issue brought up, potential risk, because we're seeing a lot of 2020 candidates, Democratic candidates, talking about expansive programs like a Green New Deal, Medicare for All. What kind of impact would that have on sort of the deficit? What risks does that pose, if any?
So I think we've said for a long time that the U.S. fiscal policy is unsustainable and the debt path in the U.S. is unsustainable. It's largely due to the fact the population's aging, and so some of the entitlement programs will grow relatively rapidly over time, particularly as the baby boom generation ages, and that'll increase spending and worsen the fiscal picture. So that's something we've been concerned about for quite some time. At the same time, we also see there's quite a lot of let's say, fiscal needs in the U.S. in order to address some of these issues that we've highlighted in the report, some of the inequalities and social issues that we've highlighted. So those things certainly cost resources to some extent. They're not a large drain on resources, but they would require some resources. However, we think that there is a path where both those investments in social and human capital can be made, and the deficit can be brought down over time. To do that, as we've highlighted in the report and the Managing Director had mentioned, there needs to be some effort to tackle entitlement reform in Medicare and Social Security, trying to reduce the cost inflation in healthcare provided by the federal government. We also think there's a need to raise revenues, either through a carbon tax, through an increase in the federal gas tax. We've advocated for federal VAT as well. So there's a number of tools at their disposal that can be used to achieve this fiscal adjustment while providing resources for the other spending needs that we see are necessary or would be useful. And we've kind of trying to highlight that package within the report.
Thank you, Nigel. So we'll take the last question then.
Yes, I apologize, but I haven't had a chance to review the Article 4 yet.
Can you switch on your mic, please?
I apologize, but I didn't have a chance to read the Article 4 yet, but I did read the G20 surveillance note. And I took note of a paragraph in which you said many advanced economies can use structural reform to enhance growth. What would you recommend in that respect for the U.S. economy? Are there structural reforms that the U.S. could undertake that would increase growth? Thank you.
Yep. So as we've sort of tried to highlight in this consultation and past consultation, we think things that would increase worker productivity, including investments in health and education, would be useful in the U.S., particularly things that increase access to both health and education, things that would improve retention rates, for example, at college, improving science and technology education at K through 12. Those would be useful. We've also, in this report and in the past, highlighted immigration reform as something, a skills-based immigration reform as something that can enhance both labor productivity and also increase the supply of labor in the U.S., which would help for long-run growth. And I think also putting the fiscal situation on a more sustainable trajectory in the end will reduce risk premium in the U.S. and will help support long-run growth.
Maybe Daniel, piggybacking on that question, can you speak a little bit about market concentration issues and maybe infrastructure? There are two other issues that we think can really help in terms of medium-term growth.
Right, yeah. Thanks, Alejandro. Yes, another trend we've been following that relates to investment and innovation is the rise in corporate market power. This has been the case in many sectors in the US, from airlines to pharmaceuticals to high-tech companies. And we found in some work we published in the April WEO, but also earlier, that this eventually, if it continues, can reduce investment and innovation. So really thinking hard about how to address the rise of market power and ensure that markets remain contestable. That's going to be an important part of the menu for structural reform to raise long-term living standards in the US.
Infrastructure.
And on infrastructure, absolutely. As Nigel said, this is something we've advocated a lot. You have to find resources to pay for it. We've advocated for a federal gasoline tax to help pay for the potholes, repairing the bridges and the roads. This could really improve people's lives by making the commute time lower. And this is something that we know the authorities are thinking about, and it's an important part of the overall mix for raising living standards over the long haul.
Thank you, Daniel. We will make Madame Lagarde's remarks available to you now, straight away, so we'll get those to you. You have the staff concluding statement, and in a few weeks you will have the full report, the Article IV report, once our board has had a chance to discuss and review it in the usual way. So let me just thank you all for coming here this morning. We appreciate it. And thanks to my colleagues up here on the podium. And we look forward to seeing you soon. Thanks.